You know when you look at a financial chart and it just seems like a bunch of random, chaotic lines? Well, I'm going to let you in on a little secret. It's not random at all. It's actually a story. It's a story about a battle between buyers and sellers, about fear and greed. And today, we're going to learn exactly how to read it.
So take a look at this. Right now, it probably just looks like a confusing map with no directions, right? The big question is, can you actually navigate it? Well, stick with me, because by the end of this, you're going to have the compass you need.
All right, so our first tool, our compass, is something called the trend. This is the single most important thing, you guys. It's what helps us see the main direction the market is heading and helps us cut through all that distracting noise.
So what is a trend, really? Well, it's actually pretty simple. It's just a primary direction of the market's movement. Think about it like a big river. Yeah, you've got little whirlpools and currents going sideways, but the entire river itself, that massive flow of water, is heading in one dominant direction. That's the trend.
And you know what's kind of crazy? It's really this simple. At any given moment, the market is only doing one of three things. It's going up, it's going down, or it's just kind of drifting sideways. That's it. We just give them fancy names: uptrend, downtrend, and sideways trend.
So let's break that down just a little bit more. An uptrend is simply a series of higher peaks and higher valleys, kind of like you're climbing up a set of stairs. And a downtrend? You guess it, it's the exact opposite, a series of lower peaks and lower valleys, like you're walking down those same stairs. That simple structure, that's the whole key to spotting them.
And check this out. This is a perfect example of a downtrend out in the wild. Do you see how each major peak is lower than the one that came before it? That red line connects them and makes that downward slope absolutely crystal clear. See? This isn't random. It's a pattern. It's the story of sellers being in control of the market. Okay, so if the trend is the main direction, what stops the price from just shooting off in a straight line forever? Well, that brings us to our next big idea: support and resistance. The easiest way to think about them is as the floor and the ceiling for the price.
You can literally see it happening on this chart. When the price falls, it hits a level and bounces back up. That's support, that's the floor. And when it rises, it hits another level and gets pushed back down. That's resistance, the ceiling. The price is just constantly moving between these two invisible barriers.
Now this is the really cool part, because it's all about psychology. These levels aren't magical, they are basically areas of collective market memory. Support is a price where a ton of buyers remember thinking, hey, that was a good deal. So they step in and buy again, and that stops the fall. Resistance is the total opposite. Sellers remember it as a great place to take profits, so they sell, and that pushes the price back down. It's just this constant battle.
So what happens when we combine these two ideas, the trend and the floor and ceiling? Well, you get something incredibly useful: a channel. By connecting these support and resistance levels, we can actually see the path that the price is walking on.
And hey, you can do this yourself. It's a super simple two-step process. First, you draw your main trend line connecting the lows in an uptrend or the highs in a downtrend. Then, you just draw a parallel line on the other side. And boom, you've just mapped out the channel.
Here's a perfect example of what we call an ascending or rising channel. That lower line is our trend line, and it's acting as support. The upper line is acting as resistance. And together, they create this really neat upward sloping path for the price to follow.
And of course, here's the opposite: a descending channel. I mean, you can clearly see how the price is just contained within these two parallel downward sloping lines. It's almost like a slide, just guiding the price steadily lower.
So you're probably asking, how much can I actually trust these channels? And that's a great question. Here's a key piece of wisdom. Think of each time the price touches one of these lines as a test. The more times the price tests these lines and fails to break through, the stronger that boundary becomes. A channel that's held for a long time under a lot of testing, it's like a battle-hardened wall that everyone starts to respect.
Okay, so we can find the direction, we can see the path. Now what? What do we do with this information? Well, it all comes down to one golden rule. You've got to go with the flow.
This quote right here, this is basically the entire strategy in a nutshell. Going long just means you're buying, hoping the price goes up. Going short means you're selling, betting the price will fall. So in an uptrend, you look for opportunities to buy when the price pulls back to its floor. And in a downtrend, you look to sell when it bounces up to its ceiling. Simple as that.
Look, if you only take one single thing away from this whole explainer, let it be this: do not try to fight the river's current. See the path that the market has already laid out and just follow it. The most basic and the most powerful principle in all of trading is to trade with the trend, not against it.
There's a really famous saying, the trend is your friend. But here's the thing about friendships. They don't always last forever. So the real question is, when that path finally ends and the trend breaks, are you ready for that moment? But hey, that's a story for another time.